let's go forward to the new book, which just came out, Navigating Big Debt Crises. You mentioned you decided to write that because a couple of folks asked you to put it together, Ben Bernanke, Tim Geithner, other people. I really like the way the book is assembled. It's broken into 3 parts. The template for what the big debt cycles look like. Then you use 3 detailed cases, the Great Financial Crisis, the Great Depression, and the Weimar Republic. And then you put together 48 case studies from the past century. So let's start with the first one, the template. What makes all of these very different crises follow the same mechanical sort of cycle? How is that even possible?
Well, everything's got these cause-effect relationships, and the way, in a nutshell, I'll try to make it simple. There's productivity. Over a period of time, our living standards rise because we learn how to do things better, and the output per man-hour worked increases, and that moves at a fairly, it'll go up and down its pace, but by and large, it's not what causes volatility. And around that, we have 2 debt cycles. We have a short-term debt cycle, which we understand because that's the business cycle. You're in a recession, central banks ease monetary policy, they change the relationship between short-term interest rates, long-term interest rates, asset prices, put liquidity in, and then you have debt growth. Credit is spending power. Mm-hmm. So when you extend credit, you are extending spending power, and that's good for the economy when that credit can be paid back. And what it does, of course, is it pushes asset prices up while levels of debt continue to increase. And at that part of the cycle, people and everybody is sort of conservative about that, and it pays back. But asset prices rise.
When you say pay back, you mean the borrowers have the ability to service that debt even as asset prices rise.
That's right. And everybody wins, and that's good credit growth, and it's a wonderful thing. Then as you get later in the cycle, it's a very self-reinforcing cycle because as asset prices go up, you have more collateral, people are more confident, they believe asset prices will continue to rise, they become a little bit less careful in terms of that kind of lending, they extrapolate that into the future. And then, and of course, then there's the shadow banking system. Mm. There's always a shadow banking system.
Really? Not just 08, 09? That's always existed?
No, all the time there's always a shadow banking system. There's a shadow banking system now. In other words, there's the banks, and they're regulated and controlled within their parameters. And then outside of those banks are other kind of new forms of lending, and capital markets and so on, or it could be online, it could be different forms. And there's a pressure to develop that outside of the system's shadow banking because the more regulated, more controlled one doesn't make as much money and so on. And so by being at the periphery, you can use higher amounts of leverage, you can do certain things, and so that grows. So you develop this shadow banking system, which is not regulated, and also investors want to go to because they'll give you a bit higher return. Even think about how the money market funds develop because by comparison to banks and so on. And so that develops outside. And it becomes so self-reinforcing because everybody makes money at it, and also they believe it because when things go up, everybody thinks things will go up.
So less regulation, more risk, better return.
That's right.
And that's late in the cycle, and then what happens?
And of course, what that does is all that demand and liquidity causes rates to come down, liquidity to go out. So like we see in this cycle. Last cycle, we brought interest rates basically down to 0, practically down. That wasn't good enough. So central banks bought $15 trillion of assets, push the asset prices up, push liquidity into the system, and so asset prices go up and people extrapolate. And the funny thing about it is, as you get to later in the cycle, when there is more debt, and you know that you're coming closer to the end of the cycle, there is more of an extrapolating in the market prices of of that moving on. So if you look at what the discounted growth rates are, late in the cycle they become high, they're difficult to meet, and then you get the changing, you get the tightening of monetary policy. Tightening of monetary policy has its effect first on asset prices, and then it becomes a self-reinforcing effect. And that's the normal business cycle, a normal sort of debt cycle, because debt is credit, and credit is buying power, and economy runs on that. Then you have this longer-term debt cycle, which is the accumulation of those other cycles, because the world wants to be long. The world wants to be leveraged long. They want everything to go up. We all do. You know, central banks, better times, assets go up, businesses activity, and so on, and there's a strong desire to push credit. And so the limitations that start to encounter is when you get close to zero interest rates, like we hit zero interest rates, that changes the game. And when you have, and then you need to print money and buy assets. That happened in 1932. So 29 to 32, interest rates hit zero. The central banks need to buy assets. They buy assets. They cause that carried to 1937. Very similar situation that we've been in. And so when we carry that from 2008 and 9, then you come into about a year and a half ago, we start to tighten the monetary policy. We pull that in. We have higher rates of debt growth. That thing goes on and on all over. In all countries, that same basic dynamic. There's a lot more on that in the book. I mean, we don't have the time to go through
So let me pull you forward to today. Given that these things are cyclical, they repeat, they look very similar, what parallels would you draw from history to today? What era does today most remind you of? What's the most intriguing aspect of the current setup?
Well, the most recent period that's analogous of this is the late 30s. Let's say if you take 1937. So why do I say that? I'd say we're well along in the business cycle, the short-term debt cycle. We're in the 7th or 8th inning of that. Central banks are tightening monetary policy. That's where we are in that cycle. Similar to then, when we have, because of the printing of money and because technologies and other reasons, we have a greater amount of polarity, political polarity. I think this is an important issue. And that political polarity causes populism around the world. In other words, a strong individual to come in, get control of that situation while they're having that type of polarity. So the word populism, for example, in developed countries was not widely used until, you go back to the 30s, until more recently. Now it's, of course, common. And so we're also late in the longer-term debt cycle, meaning if you were to turn down, if the economy was to turn down, the ability to deal with that with lowering interest rates is very limited. And the ability to deal with that with quantitative easing is very limited for a variety of reasons. So it's very much like the late 30s. You can't find a time in which both of those circumstances exist. Populism together with that differences, wealth gaps, and so on. And then also we have a situation which is quite similar, I think, in we have a rising power in the form of China.
Let's talk about that, because in the 30s you had Italy and Japan and Germany rising to challenge the existing powers. How parallel is a growing China today to that era?
I think it's not only analogous to that era, but there's a concept called the Thucydides trap, by the way, that in an excellent book by Graham Allison called Destined for War, he goes through, but you can study it.
Destined for War.
Well, he's dealing with China relationship. But another excellent book, by the way, is Paul Kennedy's The Rise and Decline of Great Powers. And if you study history, I've made a point now to study history over the last 500 years very, very carefully. What you see is that in the last 500 years, there have been 16 times where a power comes to challenge an existing power, a rising power. So like you say, in Germany, within Europe, or Japan within Asia, that was the nature of that beast. That means that there's certainly rivalry. So a trade war A comparable power creates an issue.
So 16 previous examples of a rising power.
12 of which led to actual shooting wars.
So
I'm not saying we're going to get into a shooting war, but I am saying that the history has shown that when you have wars, after a war you have a dominant power and you have periods of peace because you have a dominant power. After World War II, the United States was powerful both economically and also it had a monopoly on nuclear power. And so as a result of that power, the United Nations is in New York, the World Bank and the IMF are in Washington, D.C., because it determined that. And in history, then when you have the rising power to challenge the existing power, you have elements of conflict. I'm saying, I don't want to overdo this, but I am saying that we are entering an era in which anybody who reads history and policymakers around the world and recognize this, that this issue with China rising means that there are naturally going to be conflicts. And how do you resolve conflicts in a world market? You don't go to a court system. There's not a rule of law in the world that becomes dominant. So there is more of a rule of power, and that's a dynamic. So all I'm saying is, if I was to pick, you asked me when is most analogous. And I would say that the 1930s, where you take that period, the late 1930s, is an analogous period if you were to say cause-effect relationships, because how much power do we have in terms of monetary policy? How much populism do we have? Analogous, these are important things. And then also, where are we in the economic cycle? How are asset prices priced? And so on. So it looks the most analogous period. You can go back to periods and other periods in history, and you can find also other analogous types of periods.